Days before its $1.77 trillion IPO, SpaceX is executing a $26 billion circular accounting scheme with Google to mask a catastrophic $5 billion annual cash bleed. They are trying to rent out their most critical AI infrastructure to direct competitors just to manufacture artificial revenue for Wall Street. This aggressive financial engineering isn't just a red flag, it is a perfectly legal, multi-trillion-dollar boiler room operation. Retail investors and passive index funds are blindly marching into a massive liquidity trap, heavily disguised as a aerospace innovation. Beneath the sleek rocket footage lies the largest institutional wealth extraction scheme in modern financial history. Let's tear apart their S1 filings and expose the artificial intelligence snake oil actually driving this offering. As of recording this video, the debut of Space Exploration Technologies Corp, or SpaceX, will be on the Nasdaq exchange under the ticker symbol SPCX tomorrow morning. But the sheer gravity of this offering's quantitative metrics has generated an absolute frenzy of institutional and retail FOMO unseen since the peak of the dot-com era. SpaceX is offering 555,555,555 Class A shares at a fixed, non-negotiable price of $135 per share. The objective? To raise $75 billion in gross proceeds. That completely obliterates the previous global record set by Saudi Aramco $29.4 billion public debut back in 2019. At this fixed price, SpaceX commands an immediate implied market capitalization of approximately $1.77 trillion. Before it even trades a single public share, SpaceX will instantly become the 7th most valuable publicly traded company in the United States, trailing only established, immensely profitable technology monopolies like Apple, Microsoft, and Nvidia. The institutional demand for this offering reflects absolute market mania. Order books are currently running at nearly 4 times oversubscribed, accumulating over $250 billion in institutional demand for that $75 billion allocation. The prevailing market sentiment has been reduced to a singular, unquestioned maxim: never bet against Elon Musk. This massive oversubscription is driven entirely by the intense Elon Musk reality distortion field, forcing investors to operate out of pure fear of missing out rather than applying traditional business analysis. Looking closely at this mania triggers a surreal sensation reminiscent of the movie Jacob's Ladder, a chilling feeling that our collective financial reality is actively breaking down, descending into something fundamentally batcrap insane. Historical caution from the dot-com bubble and the 2008 real estate crash tells us exactly what happens when market bubbles inflate to this degree. Yet, eager investors are willingly ignoring red flags just to catch a trend. When you critique the fundamental business logic and compare the actual revenue of SpaceX launch capacity to a digital service like OnlyFans, the valuation disconnect becomes absolutely laughable. The SpaceX IPO on June 12, 2026 is not a celebration of space exploration. It functions mechanically as the largest, perfectly legal institutional liquidity extraction scheme in modern financial history. Now look at their revenue. 2025 revenue was $18.67 billion, representing 33% year-over-year growth, heavily supported by Starlink. But their 2025 net loss was a staggering $4.94 billion, which is a brutal reversal from the reported $791 million profit in 2024. To make it even worse, their net loss for the first quarter of 2026 alone was a catastrophic $4.8 billion, an accelerated cash burn driven almost exclusively by AI capital expenditures. To understand the architecture of the SPCX offering, you must look past the sleek rocket footage and examine the underlying market mechanics. Because let's be real, they bear a striking resemblance to the operations of historic boiler rooms, executed on a multi-trillion-dollar fully legal scale. In classic penny stock operations, most famously popularized by the Wolf of Wall Street, the brokerages relied on a 3-pronged mechanical trap. First, they hyped an artificial narrative based on the future technology to obscure a total lack of current fundamentals. Second, they strictly locked the tradable float by preventing retail clients from selling their shares. And third, they utilized artificial forced buy pressures to ensure early insiders and the brokerage itself could use the retail base as exit liquidity. Wall Street is currently executing this exact mechanical playbook with SpaceX. The people purchasing SpaceX shares on Friday are not buying an equity stake in a viable, profitable rocket manufacturer. They are purchasing the bait in a massive liquidity trap designed to systematically extract capital from passive index funds and the American middle class. The foundational necessity for this complex extraction scheme is the company's severe, undeniable lack of fundamental profitability. A review of the GAAP, generally accepted accounting principles, reality detained in the S1 filing completely shatters the illusion of self-sustaining enterprise. While SpaceX reported that its 2025 consolidated revenues jumped an impressive 33% to $18.67 billion, driven heavily by its Starlink satellite internet constellation, the company concurrently booked a staggering $4.94 billion in net loss. This massive deficit represents a severe, terrifying reversal from a reported $791 million profit in 2024, highlighting an aggressive, deteriorating bottom line. And the financial hemorrhage has only accelerated into the current fiscal year. In the first quarter of 2026 alone, SpaceX posted a catastrophic $4.28 billion net loss. That brings the company's total accumulated deficit to a mind-boggling $41.3 billion. Furthermore, the company carries a suffocating $29.1 billion in total debt, which includes a $24 billion bridge loan set to mature just 15 months after the expected IPO. Look, if a traditional logistics, manufacturing, or telecommunications company bled nearly $5 billion annually while carrying massive short-term debt, justifying a $1.77 trillion valuation, which is roughly 94.7 times its annual sales, would be a mathematical impossibility, an absolute dumpster fire. But this is Elon Musk we're talking about, and I'm sure there's some people typing in the comments right now saying, but it's Elon, he's revolutionizing the space. Who cares? The underwriters recognized this fundamental disconnect. They knew that if a company losing $5 billion a year cannot be priced at nearly $2 trillion as a rocket manufacturer, the underlying corporate narrative had to be completely rewritten. They could no longer sell just the public rockets, they had to sell them artificial intelligence to justify that insane $135 share price. And to do this, SpaceX engineered a complete destruction of its own corporate identity, pivoting aggressively to exploit the ongoing AI bubble. The visual and rhetorical strategy of the IPO roadshow completely transitioned from aerospace engineering, and instead, they focused almost entirely on data centers, server racks, and enterprise computing. Because the core space launch business and the Starlink internet constellation are nowhere near profitable enough to support a $1.77 trillion valuation, the IPO pitch deck claims a virtually limitless TAM of $28.5 trillion. Let me repeat that. $28.5 trillion. That is a figure equivalent to the entire gross domestic product of the United States and Japan combined. Sounds completely unrealistic to someone smoking crack. But to anyone who's not, it's fucking snake oil. A granular parsing of this S1 reveals the source of this inflated TAM. SpaceX attributes approximately $26.5 trillion, or 93.1% of this entire market opportunity, directly to enterprise AI applications and AI infrastructure. Only a minor sliver of the TAM is attributed to traditional rocket launches at 1.3% and connectivity at 5.6%. SpaceX is positioning itself not as a rocket company that dabbles in broadband, but as an AI infrastructure monopoly that just happens to shoot things into orbit. But looking under the hood, much of this valuation is predicated on XAI and Grok, technologies that many independent analysts dismiss as overhyped AI snake oil, or worse, a structural dumpster fire. If you're sitting there wondering why a company primarily focused on space infrastructure is valued based on AI technologies that are deeply underwhelming in practice, you are asking the right question. The foundation for this narrative shift was laid in February 2026 when SpaceX executed an all-stock merger with xAI, Musk's artificial intelligence venture responsible for the Grok large language model. The merger, which valued the combined entity at $1.25 trillion, allowed SpaceX to absorb xAI's data centers and massive GPU clusters, pitching a future of off-Earth AI data centers powered by unconstrained solar energy. However, the economic reality directly contradicts the narrative. While AI-related terms account for 47% of the segment-specific language in the IPO prospectus, the AI division generated only a pathetic 6.7% of the company's 2025 revenue, excluding legacy X-platform advertising. More alarmingly, the AI segment posted a catastrophic $14 billion free cash flow loss in 2025. Starlink's connectivity business is currently delivering virtually all the company's free cash flow at an outstanding 63% EBITDA margin, effectively subsidizing the massive unchecked capital drain of the AI division. Wall Street is utilizing artificial intelligence as the ultimate buzzword to distract retail investors from the multi-billion-dollar hole in the balance sheet. To obscure this extreme cash burn ahead of the SEC filings, SpaceX engaged in a highly sophisticated multi-billion-dollar accounting maneuver that industry analysts have characterized as circular financing. The operation relies on strategically timed computing contracts designed to inject massive artificial revenue streams into the company's books immediately prior to the June 11th pricing. On May 6, 2026, SpaceX announced a massive cloud service agreement with Anthropic, the AI safety company behind the Claude models, worth $1.25 billion per month. This deal granted Anthropic exclusive access to 225,000 NVIDIA GPUs housed at xAI's Colossus One data center in Memphis, Tennessee, through May 2029. Less than a month later, via an amended S-1 filed June 5th, 2026, SpaceX revealed a second parallel contract with Alphabet's Google. Google agreed to pay SpaceX $920 million per month, totaling roughly $30.3 billion through June 2029, for access to an additional 110,000 NVIDIA GPUs and related compute components. Combined, these two contracts injected an astounding $26.1 billion in annualized recurring revenue into the SpaceX income statement, radically transforming the narrative from a company burning cash to an AI infrastructure cash cow. The strategic implication is a textbook circular financing dynamic. Google owns roughly 5% of SpaceX, elevating its equity value to over $100 billion at the IPO. The structural conflict of interest, however, lies dead in the capitalization table. Google is not merely a customer in need of computing power. Alphabet is a massive, long-time equity investor in SpaceX. In 2025, Google and Fidelity injected $1 billion into SpaceX, securing roughly a 10% stake in the aerospace company. Following years of delusion and the xAI merger, regulatory filings confirmed that Alphabet's stake sat at an approximately 6.1% by late 2025, adjusting to an estimated 5% post-merger. At the target IPO valuation of $1.77 trillion, Google's 5% equity stake in SpaceX instantly balloons to a value exceeding $100 billion. This dynamic exposes the absolute circular nature of financing. Google pays SpaceX roughly $11 billion a year for compute power. This contract artificially pumps SpaceX pre-IPO revenue metrics, allowing the underwriters to justify $1.77 trillion valuation. In return, Google's private equity stake becomes worth over $100 billion post-IPO. It is a closed-loop accounting illusion, moving capital between connected corporate treasuries to maximize the public offering price and impress uninformed retail investors. While Google publicly attributes this massive move to an unexpected demand for Gemini Enterprise, a closer look reveals this as pure marketing rhetoric. The aggressive integration of AI into long-established legacy products like Google Search makes these usage patterns completely forced and artificial rather than organic. This entire argument points to a grim outlook for the broader AI market, acting as a flashing red light for a potential society implosion as these speculative trends unfold. Beyond the shady accounting maneuvers, the Anthropic and Google contracts expose a glaring logical trap regarding SpaceX's foundational AI thesis. The global technology sector is claiming that they are currently experiencing a severe GPU shortage, leaving major AI companies critically compute constrained. SpaceX and XAI explicitly stated that their core growth strategy relies on building the world's most powerful AI models, utilizing the Colossus supercomputer, which was built in a record 122 days inside an abandoned Electrolux factory in Memphis, to train Grok architecture. Herein lies the paradox. If XAI and SpaceX are truly positioned to dominate the $26.5 trillion enterprise AI market, and raw compute power is their most critical strategic asset, why the fuck are they renting 330,000 of their most advanced NVIDIA GPUs to their direct competitors days before going public? Well, by granting Anthropic and Google exclusive access to vast swaths of the Colossus infrastructure, SpaceX is effectively arming its rivals in the most consequential technological race in history. The operational data provides the definitive conclusion. SpaceX is not renting out these critical assets because of unexpected demand or a surplus of capacity. They're renting them out because the XAI division reported an operating loss of $2.47 billion in the first quarter of 2026 alone, accumulating $20.4 billion in AI capital expenditures between 2025 and the first quarter of 2026. They are sacrificing long-term AI model supremacy to exchange short-term financial engineering. And the architects of this offering need a massive pool of retail money to hold the stock artificially high, providing a stable exit for insiders. They weaponize brokerages under the myth of democratization. SpaceX reserves 30% of its float for the public, with Fidelity dropping account minimums to $2,000. But the reality is predatory. To prevent a retail sell-off, brokerages instituted a 15-day anti-flipping policy. Selling within 15 days triggers a permanent lifetime IPO ban that is tracked via social security numbers. This 15-day retail leash exploits passive index funds, converting American retirement accounts into forced buyers. The S&P flatly rejected SpaceX due to massive gap losses, so management used a fast entry loophole on the NASDAQ. Any stock maintaining top 40 market capitalization within its first 15 days automatically joins the NASDAQ 100 index. The trapped retail supply artificially holds the valuation for 15 days. Once index inclusion triggers, massive index funds are legally mandated to blindly purchase the stock at any market price, providing perfect price agnostic exit liquidity for venture capital insiders immediately. Purchasing stock is not buying equity, it is a non-refundable donation to a corporate dictatorship. Dual-class structures grant Elon Musk 10 votes per share, giving him 82.4% voting power, exempting SpaceX from independent oversight. Him routing the recent XAI merger through Nevada legally shields management from fiduciary liability. Retail investors absorb 100% of the risk with zero oversight. This entire public offering mechanically extracts middle-class wealth to mask venture capital losses, inflate valuations with false narratives, trap retail supply, and dump overvalued assets onto passive American retirement systems. Now, if you guys enjoyed this video, I am going to be making a video next week about the real possibility that Elon Musk made up this whole IPO just to spite Sam Altman and destroy any real possibility of Sam Altman ever being able to put out an IPO himself. It's a real possibility, and I think it's pretty interesting. Anyways, thank you guys for watching.